Financial planning for high net worth individuals. My man Anon Amiss writes in, would you ever do a video on financial planning for high net worth individuals? Not crazy money like the Powerball winners or anything, but something on people with $5 to $10 million in assets, non-retirement assets. Now, he doesn't say if that's financial assets or total net worth. I don't know, but he says, I've never seen any YouTube videos on that from any of the financial people I follow. All right. I'd like to see your opinions on how much they could withdraw and spend and how they set up their investments to be safe yet keep growing in order to leave a tremendous legacy. All right. This is actually pretty easy. So we're going to start with a couple with we'll just say 5 million, 10. It doesn't, frankly, it does not matter. All right. So remember, a couple of things to consider is when it comes to financial planning in terms of how much you can withdraw and all that, the percentages are all the same. It doesn't matter if you have 100,000 or 100 million. If you're trying to preserve and maintain your wealth, I say a 5% inflation adjusted is fine. And the reason I say it is because what's likely going to happen as you age, you're going to spend less and need less from your portfolio. So I'm fine with that. I frankly don't care how old you are. I'm just telling you, this is my belief. I say 5%. Now, if you really want to be if you really want to make it simple, you start the 1st of January and you say, I got 10 million bucks. I'm pulling $600,000 out. All right. You pull 6% a year, whatever the portfolio value is. It's so easy. Now that's different than a 5% adjusted for inflation. This is just a 6% withdrawal amount. And so sometimes you're going to be pulling 6% on a 10 million bucks is $600,000. If the market goes down to 8 million bucks the next year, that's $480,000. You will never run out of money if you follow that. It's just that simple. It's kind of like the scenario like if you have if you go halfway to an object each and every step. So I got this object and this finger. I'm only going halfway to this object each and every step. In theory, I actually never touch that object because I'm still always just going halfway. So I never actually touch it. That makes sense. It's the same scenario here with a 6% withdrawal rate every year is that you literally never run out of money because you're withdrawing 6% of whatever the portfolio is worth. If the portfolio is worth $5, you're only withdrawing 6%. I mean, it's facetious, but it works, man. It works because you're not going to be around for freaking 50 years. You're going to be around for 30 at most. Take 6% a year and be done with it. I mean, that's just the way I do it. But the problem, of course, is that means you got to cut back when the markets go down. How many people can have the ability to do that? Well, frankly, I think a lot more than you would think, because if you go into retirement debt-free, you can cut back when the times get called for it. But that's way some people like a more planning approach that says, all right, I don't want to have to cut back from 600,000 to 480,000. In that case, you just take 5% a year, adjust it for inflation, be done with it. That's simple. And when I say adjusted for inflation, it's literally not even like, well, inflation was at 2%, so my 5% would be 5.02 this year. I'm not even saying it's just common sense. Like, all right, you took 5% off your portfolio, you dumped it in a checking account. How much did you spend of that? And then just do it again, man. It's not that difficult. I'll do a different video on this at some point. All right, be that as it may, but always remember, it's always percentages. All right, first and foremost. Now, what does a guy and a lady who've got $5 to $10 million do? Well, the first thing is you got to remember your estate theoretically will grow. So at a 7.2% rate of return, that 5 to 10 millions will be worth 10 to 20 millions in 10 years. Now, that does not include any distributions, I grant you. But you always got to remember the estate is growing. And so one of the things that we want to do in terms of legacy building is we want to reduce the value of your estate while you're alive. And you do that with you taking advantage of the gift tax exclusion. So you got two kinds of gift taxes. You got annual gifting, and that's 100. I think it's $15,000 per year. So you could give me $15,000. You could give Charlotte $15,000. You could give all my kids $15,000 per year, completely gift tax free. You don't even have to file a 709 because it's the annual exclusion. So one of the things you want to start doing in terms of the gift tax to reduce your estate is taking advantage of your annual exclusion amounts. So the amount that you give per Social Security, if it's $15,000, it's not subject to any tax writing, any form, nothing. You just say, here's a check for $15,000. See ya. Is that so? Or you say, here's $15,000 worth of stock. I don't like that so much, but you could do that. See ya, and you don't have to account for it or anything. And that's a very effective strategy to reduce your estate, without question. Without question. Because remember, one of the things we want to be clear is estate planning includes the ways to not only minimize estate taxation, but really to reduce your estate. And the way to reduce your estate is just give assets. That's all there is to it. And remember, an irrevocable trust, you're literally giving assets to a other entity that has its own 1040, it files a 1041, has its own Social Security number and everything. Well, it's actually tax ID. So you're literally giving money to this trust, this essentially a business entity, and when I'm giving it, that is still subject to the auspices of a gift tax, because I'm literally giving it away. And so if I'm giving $3 million to an irrevocable trust, or irrevocable, however you want to say it, it's the same thing. That's a $3 million gift I'm making to this trust. I'm reducing my estate by $3 million. The first $15,000 of that falls under the annual exclusion, which I don't have to declare in anything. It just is free and clear of a gift tax. The next, whatever, $2.985 million is still free from gift tax because of the lifetime exemptions. And it's like $5.25 million or something like that right now. I can't remember. So you have $5 million you can give over the course of your life without being subject to gift tax. All right. And so what happens is you fill out a 709. You tell the IRS, hey, I think it's a 2-pager. I gave, $2.985 million or whatever it is to this entity, a person, a trust, it doesn't matter, to some kind of organization with its own separate tax ID. And because I'm taking advantage of my annual gift exemption, it doesn't matter, but my lifetime gift exemptions, I will reduce my future lifetime gift exemptions by the amount I give today. So if I have $5 million of lifetime gift exemptions, I can literally give $5 million to anyone over the course of my life, gift tax free. If I just gave, $3 million, I'm still left with $2 million, my friends, in which I can give gift tax free. That money is now free from any gift tax. It's also free from any estate tax because it's no longer part of the estate. This is a huge thing that a lot of people don't do. And so what you're doing here is you're giving it to this irrevocable trust, and the irrevocable trust, a trustee, which won't be you. Heck no, you're not the trustee of an irrevocable trust. Is managed according to the wishes of you who granted the money and created the trust. All right, now you really aren't supposed to be a huge beneficiary of this trust. There's things called health, education, maintenance, support. I'm not going to get into here, but at the end of the day, you can't just go in the trust and pull money out as you see fit. That's not how it works. It's literally got to be removed. It's got to be a Chinese wall that separates that assets from your ability to manage, if that makes sense. So you're giving away to the irrevocable trust, and the irrevocable trust as a trustee, a lot of times it's going to be a third party, not part of your family, because the IRS is keen on these things to look at. They say, did you really sacrifice control of this, or are you just doing it for a tax reduction strategy? IRS isn't stupid here, and they shouldn't be. I mean, they know what's happening. I can't tell you if people set up these irrevocable trusts and think they can just go in there and draw it as they see fit. Now, it doesn't work like that. Now, again, the trust can grant you, it used to be like 5 and 50. I can't remember what it is. It's been so long since I actually did this on a regular basis, but 5 and 5, you could take 5% of the assets or $5,000 a year without having to fill out a crummy letter. And then there's also health, education, maintenance, support, where you can take money out to basically provide for your health, to provide for your education, provide for your maintenance. What is that? And the IRS is on this. They know if you're taking out to live large as possible, they know you essentially have not sacrificed control of that trust, and they'll put it back in your estate when you die. You just got to be careful. I've seen lots of mistakes in this regard. Anyway, an irrevocable trust has its own tax ID and its own not a 1040, it's called a 1041. So I'm not keen on setting up these trusts. I know a lot of people are. They think it's all that in a bag of chips. They'll have these ILITs, life insurance, or irrevocable life insurance trusts. I'm just generally not a fan. Charitable remainder trust, generally not a fan. It's just all this stuff is white elephant stuff. It's applicable to few and far between. It's not applicable to most people with $5 and $10 million bucks. Just not. So what you'd want to do is you start a gifting strategy to get the money out of your estate. And frankly, I just start doing it with charitable entities and your family. You start saying, hey, start giving it to your kids right out of the gate. And don't wait until they're 25, 35, and 45. I mean, there's a lot of trusts are set up that the beneficiary, your kid, can get a third of it at 25, a third at 35, a third at 45, and so on. That's just dumb, man. Don't do that. Why punish your kids, man? Are your kids going to be freaking sniffing up their nose? If they're not, and they're good and they're married to a good spouse, let them have the money and do it as they see fit. And the way you do that is you give it to them. Say, hey, Johnny, I know you and Janie are struggling right now. Here's $250,000. And then what you don't say this, but in the back of your mind, you can see how they manage it. If they start snorting up their nose, then you want to make sure you set up an irrevocable trust. That way, when you die, Johnny and Janie don't sniff that up their nose and kill themselves. But you start giving money away to reduce your estate. Because don't forget, we're not only trying to reduce that $5 to $10 million estate, we're trying to reduce the future growth of it as well. This is what is a double whammy. The gifting strategy is a double whammy. You're getting money out of your estate, and you're getting the future growth of that out of your estate as well. All right. So we talked about trust. We talked about how to set up generational wealth planning. This is the way to do it. Don't wait future generations with generation skipping trust and all. I mean, you can do all that. I'm just saying it's the generation. I have a generation of kids right now. If I had that kind of money, I'd be giving it to the kids right now. You know, I'd be 13, so I'm not going to do it now. But still, when they're 25 and 35 and 45 and whatnot, they're married to good spouses. I'm going to say, here, man, here's some money. Just, spend it on a house, whatever. And if they start mishandling that, I'll be careful in my estate docs. I'm a huge fan of second to die life insurance, my friends. Second to die life insurance is the most underutilized tool other than gifting itself that there is. And I used to have one. I had to beg and freaking scratch for the Knights of Columbus to understand what a second to die. They called it dual life insurance. I had my agent in my house, and I bought 4 whole life policies, one for each of my kids. Bought long-term care for my wife and me, and I bought a second to die life insurance, which I since cashed out to start this business, actually. But what a second to die life insurance or a survivorship life insurance, but a second to die is what it's called. What it does is it's covering 2 lives. All right, so your life insurance, you're saying, hey, as Charlotte and Josh were both insured at the death of the first spouse, though, the survivor doesn't get the life insurance proceeds. It only pays out at the death of the second spouse, all right? It only pays out at the death of the surviving spouse, Charlotte, because I'm older and I'm a man. Most likely I will predecease her. When I die, she doesn't get any life insurance benefit at all. It only pays out when she dies, all right? So the reason why second die life insurance is great is because it's cheaper than just life insurance, because life insurance covers one life, and it pays out at the death of that of that insured. We don't want this money to go to Charlotte, or if she dies before me, to go to me. We want to go to a trust or to my kids directly, which is usually the way to go, frankly. So what you'd want to do here is a second to die life insurance. Here's how it works. You say, at the death of Charlotte, I have this $2 million life insurance policy, which will transfer to my 4 kids completely tax-free. $500,000 a pop. It doesn't go through probate. It's completely liquid. All right, second to die life insurance. You don't need a trust in this regard. I mean, some people do it because they want to make sure it doesn't go into the estate. But at the end of but again, ILITs are very. A lot of people want to use those terms to kind of show you how fancy they are. I frankly just don't think it's that big of a deal, especially in this day and age with a large exemption on state tax. So anyway, second to die life insurance. I die, nothing happens. Charlotte keeps paying the premiums if need be, and at her death it goes to the kids completely tax-free, income tax-free. Now, it will be part of the estate of Charlotte when she dies. Again, not that all that worried about it, because the estate at that point should still be well below the estate tax threshold, so it shouldn't be subject to an estate tax. But if that's a concern, then you wanted to avoid your estate, then a trust would be the way to go. And here we got an ILIT. So what happens with an ILIT, irrevocable life insurance trust? This is all fun to talk about. It's just not applicable to many people. Is what happens is you have these things called a crummy letter. All right. So the trust is for the benefit of your children, and what you're doing is essentially you're giving you're paying the premium for the trust. You are the insured, and you're paying the premium for it for the benefit of a trust that's out of your estate or just benefit. It frankly doesn't matter. And what happens is when you pay the premium, you're literally making a gift to your children, and your children are saying, we don't want this gift. Use it instead for life insurance premiums. That's a crummy trust with a crummy letter. And it's not crummy, I guess, thinks. It's crummy to name the guy who went before the IRS or the Supreme Court, and this is how it came to be. A little bit more complex than this, but generally speaking, it just says at the end of the day, we're going to pay the premium with money that could have gone into the trust, but because we're paying the life insurance premium, we got to tell the IRS that this is legit, and we do that with a crummy letter. There's more to it than that, but it's actually a pretty good strategy. And so now the life insurance is paying from a gift from me, Charlotte and me, into this life insurance trust. The life insurance trust benefits my children, and they're not out of any cash flow at all because the premium are not paid by the beneficiaries. The premium are paid by me, which is the grantor of the trust. A lot going on there. But it's a wonderful tool, man, and no one uses it because these guys who try to explain this, they come across two sales agencies, and then people are like, I don't get it. I'll never forget. This guy used to manage a portfolio at Wellington in Boston, and he was a great guy. Love this guy. We got a freaking estate planning attorney on the horn that one of his partners knew, and I was like, dude, can this guy talk any more like a foreign entity? I was like, can you just talk away a regular joke and understand? I was so freaking disturbed by this. I was like, man, because I had this big elaborate estate plan for this guy, which he needed because he's in Massachusetts. He's going to get hammered. He had to start making gifts out of the estate. In this case, an ILIT was the way to go. With a secondary life insurance policy, I don't want to get the mechanism, the mechanics of it, but it was such a great strategy. It was ready to go. I had it all set up, man. Guy was going to make a pretty significant one-time contribution to this ILIT to buy this life insurance, a one-pay secondary life insurance policy. It was called Survivorship Universal Life. It was such a good plan. Minimum cash value, maximum death benefit. It was fantastic. And the attorney that this guy wanted to use, I got on the horn with him to kind of go over the ins and outs of this, and he was so far in the weeds. The guy's like, yeah, and the guy runs like a couple $1 billion of assets for Wellington, and this attorney was just like talking. I was like, dude, you just killed the sale. And now this guy is never going to do anything, probably because he's like, that was painful to hear. It made me feel like an idiot. Here's a guy with a CFA, a PhD, who runs billions of dollars in assets, and he felt like an idiot. A nice guy you ever meet, too. I was embarrassed. I was embarrassed I set this appointment up. Anyway, so that's what you do. You start saying, how do I get my estate reduced? How do I live on it? I live on 5% a year, done. You know what I'm saying? I live on 6% a year, done. However you want to do it. You start making gifts to entities that you want to see that you value. You can start making charitable contributions as well. But remember, at the end of the day, when you die, those assets, because they're non-IRAs, they transfer not estate tax-free. They transfer tax-free because of step-up in basis. Now, someone posted last night in my live stream that the step-up in basis is being proposed in legislation. I hadn't heard any of this to get rid of the step-up in basis. So there's legislation. Hey, it's not going to pass. I hadn't heard it. I would like to see the legislation if it's there. I don't think it's going to pass any more than we're going to reduce the estate tax limits exemptions. I haven't seen any of that. So if it's out there and it looks like it has some legs, I'd like to see that because obviously there's something for me to consider, but I just don't think that's going to be happening. So what you do is you invest conservatively. Wellesley, Wellington, you take your income off the portfolio, you start giving money away. If you want to buy a secondary life insurance policy, I think you should. That's great. Think about this too. I'll do a different video on this because this is the way this should be done to avoid a taxation. I'll do a different video on this because we're already up to 20 minutes. Love to hear your thoughts. Good question, man. I love to hear your comments too, folks. See ya.